Okay, let's start the second session for the last 25 questions. I'll take the question number 26. Accounting system in which variable costs are charged to cost unit and fixed cost of the period are written off in full against the aggregate contribution is known as, that is marginal costing. Answer is correct. Why? You will take total sales revenue and you will deduct total variable cost. Then answer is the contribution. Then against the contribution you will deduct full fixed cost, that is total fixed cost. Then answer is net profit. In such situation called marginal costing system, that is a marginal costing profit and loss, right? Therefore answer is marginal costing for the question number 26. Now read question number 2 is again a theoretical question. Right, I think you have read the question. Question number 27. If the inventory levels increase in month of production, which of the following statement is correct? If the inventory level increases, right? When inventory level increases, cost of the inventory also will increase, right? Let's see. Absorption costing gives lower profit. No, when inventory level increases, cost of closing inventory will increase. When cost of closing inventory will increase, cost of sale will decrease and gross profit will increase and net profit will increase. Therefore profit cannot be lower. B. Absorption costing and marginal costing will give the same profit. No. In the absorption costing, closing inventory will be measured including both marginal and overhead cost, fixed overhead. But marginal costing value the closing inventory including only the marginal cost, that is direct cost. Therefore it cannot be same. Periodic profit is not affected by the selected costing method. No, it will change. Therefore answer, absorption costing gives a higher profit than marginal costing. Yes, when the inventory level increasing, the closing inventory, the value of closing inventory will increase, since you will absorb more fixed overhead to the closing inventory. Therefore absorption costing closing inventory will give you a higher profit when comparing to the marginal costing. Therefore answer is D. Then let's take question number 28. A production division manufactured 100 units of product X in a month. Each unit of X consumed 14 kilograms of material and 20 labor hours. Cost of material is 230 per kilogram and cost of labor 300 per hour. Total revenue of the division 1.2 million. What is the throughput contribution per unit? I will explain this throughput theory on the whiteboard. This throughput accounting, right, you have to learn with marginal costing. Say your selling price, I will take an example, not the same story, or I will take the same story, right? The total revenue according to question 1.2 million rupees, right? Number of units 100 units. Therefore, sale price per unit will be 1.2 million divided by 100. Therefore, that will be 12,000 rupees, right? Selling price per unit. Now we can take the variable cost. Each unit of X consume 14 kilogram, that is direct material, 14 kilograms, and direct labor 20 labor hours. Direct labor 20 hours. The price per kilogram is 230 rupees. In price per labor hour 300 rupees. Therefore, per unit material cost will be 14 into 230, that is 3,220. Labor cost will be 6,000. Right. Now this can be analyzed in two ways. One, the marginal costing. According to marginal costing, you can analyze selling price 12,000 minus direct material 3,220 minus direct labor 6,000. There is no, unfortunately, variable overhead. If there is variable overhead, you have to take it, right? It is 0. They didn't mention that. Once you deduct all direct cost, once you deduct all direct cost, all variable cost, all direct or all variable cost, this answer called contribution. This contribution come under marginal costing. Marginal costing contribution will arrive after deducting all variable cost from the selling price. Let's see, 12,000 minus 3,220 minus 6,000. Therefore, according to the marginal costing, contribution will be 2,780, right? There is another method that's called throughput accounting. Throughput accounting method. In throughput accounting, we will consider contribution after deducting only material cost. Therefore, in throughput accounting, we will take selling price as 12,000 and we will deduct only direct material cost. Only direct material cost, that is 3,220. You are not going to deduct direct labor and direct overhead. That is, direct labor and direct overhead will be considered as conversion cost under the throughput accounting, right? Therefore, according to the throughput accounting, contribution will be calculated only using direct material. Therefore, according to throughput accounting, contribution will be 8,780. You can see, I think you can view your question papers. The throughput accounting contribution, according to the given answer, it would be 8,780. Now, what is the difference? In throughput accounting, to calculate the contribution from selling price, we will deduct only direct material. When it's come to the marginal costing, to calculate contribution, we will deduct all direct cost, not only material but also direct labor and variable overhead. That is the difference between marginal costing contribution and throughput accounting contribution. Is that clear? Throughput accounting means you will consider only cost you input to the production process, that the basic cost is material, therefore you will take material cost, only material cost to deduct from sales price to have the throughput contribution. That is the difference. Therefore, according to that calculation, you can see the answer for question number 28, that is A, 8780 as I calculated, because they are asking throughput contribution, right? Throughput contribution would be 8780. Therefore, from this question what you need to learn, you need to keep your mind throughput contribution will calculate only deducting selling price minus total material cost. That is the direct material cost only consider when calculating throughput accounting contribution. Let's move into the question number 29. Which of the following is not a concept that guides to identify a relevant cost of a decision? To identify a relevant cost of a decision, you know the characteristics of relevant cost. What are the characteristics of relevant cost? Relevant cost always future cost, because you never consider past cost. Past cost already incurred, consider and named as sunk cost. Sunk cost is not a relevant cost. Therefore, relevant cost always consider the future cost. Then, relevant cost only consider the cash flows. Non-cash flow expenses you will ignore. Therefore, relevant cost talk about only cash flow expenses. Future expenses, cash flow expenses, and relevant cost consider the incremental cost. That is, cost will be increased due to the taken of this decision. If you are not take this decision, you can save that cost. That is incremental cost. Therefore, major three characteristics of the relevant cost are: it is a future cost, it is a cash outflow, and it is a incremental cost. Therefore, answer is B, relevant costs are unavoidable, because you can't say relevant costs are avoidable if you can manage it. That's why you are taking short term decision. Therefore, relevant cost is not an unavoidable cost, it can be avoided, right? Therefore, answer would be B. That is the sentence not match with the relevant cost concept. Now, from question number 3, for question number 30 and 31, we have to use the information given here. Let's read this information given, because for both question number 30 and 31 we have to use this information given, right? Let's read this information given. A company normally produces 1 million units per month. At this level of production, the standard cost, right? Standard cost per unit, that means how they have set their standard per unit: direct material, direct labor, variable, indirect production, and setup cost, right? They have calculated direct material 14, direct labor 6, variable indirect 1, setup cost 3. There are 3 direct costs. However, this setup cost is very important, because total number of unit, this setup cost not change with total number of unit, it will be changed with number of setups. That's the point you need to learn, right? Now, if you take this direct material, it will be changed with the quantity, right? This will change with the quantity. This will be changed with quantity. Then direct labor also change with quantity. Variable direct production also change with the quantity. But setup cost will be changed, right? This will be change with the number of setups, right? Now you can see a difference between setup cost and other three costs. All other three costs will change according to the number of units. Setup cost will change according to the number of setups. Is that clear? Right. Setup cost is 6,000 per setup. Per setup, you have to incur 6,000. Now, you cannot say 6,000 into 1 million units because setup cost never change according to the number of units. Setup cost will change according to the number of setups. Therefore, you need to find out how many setups you require to produce 1 million. However, for direct material, direct labor and variable indirect, it will change according to the number of units. The company has received a special order for 100,000 units at 22 rupees per unit. You can supply 100,000 units at 22 rupees per unit. The company has excess capacity. That means they can produce without incurring additional fixed cost. This is very important. They have excess capacity. They have excess capacity means company can produce special units, that is 100,000, without increase their fixed cost. Because they are within the capacity. Now, here variable indirect production, actually this is fixed cost. Indirect production is the fixed cost. This will not change due to this additional 100,000 units. Why? They are within the capacity. They have excess capacity. I will give you an example. Assume you have a room with 4 beds. Room rental is 10,000. How many people can live there? 4 people. Now you have only 3 people. Can you take additional person to the room without additional rent? Yes. Why? Within the room you can facilitate 4 people. Currently you facilitate only 3. That is, you have excess capacity. Even you recruit 1 person, your fixed cost of rental not increase. Therefore, within the capacity, fixed cost will not increase even you accept additional production. The company estimate that 5 setups will be required for the special order. You required 5 setups for this special order of 100,000. What is the cost of special order? Let's calculate. I will use the whiteboard to explain the answer. Right, according to the information they have mentioned, direct material you required 14 rupees per unit. Therefore, to produce 100,000 units, you need 14 lakhs, that is 1.4 million. Right. Then direct labor, that is change according to the units. Per unit 6 rupees. For 100,000 special order you required 600,000. Right. Then you have indirect production cost. It is not relevant. Why? Indirect production cost will change when the capacity increase. Now here you have excess capacity, therefore this will not change. Then you have to take setup cost. Setup cost is 3 rupees per unit. Setup cost will change according to the number of setups, that is total production, that is 100,000 you have to take. How many setups you have to prepare? 5 setups. Yeah, you have to set 5 setups. That means to complete this 100,000 you need to take 5 sets, right? You need to take 5 sets. Per set your cost said 6,000. Therefore setup cost will be 30,000, right? Question directly mentioned you need number of sets 5. 5 setups you required. Cost per setup 6,000. These 5 sets required to produce 100,000. They directly mention the number of sets. Therefore 5 setups into 6,000, cost per setup 6,000, it is 30,000. Therefore total setup cost will be 2 million. Here 2,030,000, right? Now we need to consider this value, indirect production cost. Let's move into the screen again. Here they have mentioned variable indirect production. That's the point we need to take carefully. Variable indirect production. Now indirect production may be the overhead. Now this overhead with a special wording called variable. That means this can be considered, since it is variable, it is a fixed cost. It is as a variable cost. Why? It is overhead, but it is vary, right? Since it is vary, if that wording is not there, if it is just indirect production, you can say it is fixed, never change with the quantity. But here is a special wording that is variable. Therefore, we can consider this indirect production, since the wording variable, as a variable cost. Now indirect production, here I didn't take the wording wording variable, I just take indirect production cost. You can't take indirect production cost to the total cost, the relevant cost. However, question said they have variable, that is very important, variable indirect production cost, that is 1 rupees per unit. Therefore you have 100,000 units. This need to be considered since it is variable. Since this is variable, you have additional cost of 100,000 to the production. Therefore 2.13 million is the total production cost. Now you can see on the answer B clearly mentioned 2.13 million is the total production cost of the job. Then let's move into the question number 31. What is the profit of the specific order? You know your total cost will be 2.13 million. Your total revenue, they are expecting to give you 22 rupees per unit if you supply this. Therefore total revenue will be 22 into 100,000, that is 2.2 million minus 2.13 million will be the cost. Therefore net profit will be 70,000. You already calculated your total cost 2,130,000. They have given you the selling price 22 into 100,000 units. Therefore revenue will be 2.2 million. Total cost is 2.13 million. Therefore profit is 70,000. Answer is C. Now let's take question number 32. Which of the following item is usually not important to special order decisions? Now remember what I have explained in the previous question. If it is a fixed cost, if it is an indirect cost, if it is not vary within the capacity, it is not important. Is that clear? Because when you are accepting new order, first of all you have to see whether you have the capacity. If you have the capacity, even you accept the special order or not, your fixed cost not going to be changed. As I told you my example, you have a room with 4 bed capacity. You have only 3 people within the room. Rental is 10,000. Even you welcome additional persons to the room, your rental remain at 10,000. But if you want to increase, you have to have additional room. Then your fixed cost will increase. Therefore, within the capacity, to accept a new order, fixed cost is not a relevant cost. Which of the following item is usually not important? Effect of special order in regular business. That is very important. When you are accepting a new order, you need to consider what would be happen to my regular businesses if I accept this order. For an example, assume you are a bakery owner producing breads. Every day you are producing 1,000 breads and distributing around the area. Especially in month of May, due to the we have more alms given during this period. One of the Dansal committee will request you to provide additional 100 breads. Now what you have to do? You have to stop your production by 100, and that 100 you have to supply for that committee. Then what happened to your regular businesses? Sometimes you will lose it. Therefore, when you are getting special orders, you have to think about your existing business. What happened to that? See whether idle capacity is available. It is very important. If there is no idle capacity, you have an opportunity cost. Why? If there is no idle capacity, if there is no excess capacity, you have to stop your regular business and accept the order. In such a case, you have an opportunity cost, losing contribution from existing sales. It has to be considered. Increase variable cost per unit. Yes, it is very important. Sometimes special order will have separate variable cost when comparing to the existing production. Therefore, answer is B. Fixed cost is not a relevant matter when you are accepting a special order. Question 33. A manufacturing plant has a fixed cost of 260,000 per month. In the month of January, company had a sale revenue 570,000 and total variable cost 342,000. They are asking break-even point sales value. We know to calculate the break-even point sales quantity, fixed cost need to be divided by contribution per unit. Then you can calculate break-even quantity, but here they are asking break-even point sales value in rupees. To calculate easily, we have 2 methods. Number 1, calculate the break-even quantity, then multiply it by the sales price. But in these questions, they have not provided sales price or the quantity. Therefore, we have to have an additional method, alternative method. That is, you can divide your fixed cost by CS ratio, contribution to sales ratio. Once you divide your fixed cost by CS ratio, you can have break-even point sale value. Your total revenue 570,000, then minus variable cost of 342,000, then your total contribution 228,000. Clear? Your total contribution will be sales value price minus variable cost, then your contribution will be 228,000. Then divide it by sales value, that is 570,000. You can see your contribution to sales ratio, your CS ratio will be 40%. Now, divide fixed cost. Your fixed cost is 260,000. Divide your fixed cost by CS ratio. Once you divide your fixed cost by CS ratio, that is 650,000, right? I will show you the calculation like this. Break even point sales revenue, right? Break even point sales revenue, you can calculate fixed cost can be divided by, right? You can divide your fixed cost by your CS ratio, contribution to sales ratio, right? You can divide it by contributions to sales ratio. Now, you already have your fixed cost. How much your fixed cost? Your fixed cost is 260,000, but you need to calculate your CS ratio. To calculate CS ratio, right? Let's calculate CS ratio. How you can calculate CS ratio? To calculate CS ratio, you need to divide contribution by sales values. How? To calculate contribution, what you need to do? Take the contribution. 570,000 is the sales value minus 342,000 is the variable cost. Now you have the contribution. Then divide by 570,000. Now you can have your contributions to sales ratio as 40%, right? This is your contribution to sales ratio. Now divide fixed cost. How much of fixed cost? 260,000, right? Divide by contributions to sales ratio, that is 0.4 or 40%. The answer will be, right? Answer will be 650,000. This is the answer, 650,000. This is the one method of getting break-even sales revenue. Otherwise, you can take fixed cost divided by contribution per unit, then you have BEP, quantity, then you can multiply it by the sales price per unit, but no information available for that method. Therefore, we have to go to the second method we have explained here, right? Moving into the next question, 34. This question 34 about short-term decision. What is this short-term decision? I will explain. Short-term decisions are the decisions taken about the production quantity in the next period, for next week, for next month, or next quarter, or maximum next year. Here, this short-term decision making align with limiting factor. What is a limiting factor? You need to understand what is a limiting factor. Limiting factor means, you know, what are the production factors? Direct material, direct labor, overhead, those are the production factors. When one factor or many factors are not available sufficient enough for the required production, that's called a limiting factor, right? Here you have three products, A, B, C. This is the selling price, this is the variable cost, therefore easily you can calculate the contribution of each product. You have been given the labor hour required for each product and expected production and sales. Now, if you consider 3 into 100, A require 300 hours, 5 into 150, that is 750 hours required, 2 into 120, 240 hours required. Let's see how much the total hours required for the production of ABC. 3 into 100, that is 300, then 5 into 150, that is 750 plus 2 into 120. You require totally 1290 hours. Now currently you have 1200 hours. You have only 1200 hours, but you require for A 3 into 100 equal, you require 300 hours. For B you require 5 into 150, that is you require 750 hours. Then for C you require 2 into 120, that is you require 240 hours. Altogether you require how much? You require 1290 hours you require. But you can see you have only 1200 hours. Therefore you are facing lack of labor hours 90. This is the labor hour deficit. This is the deficit of labor hour. Therefore you cannot produce all these quantities as you expect. This situation called a limiting factor situation. The limiting factor is labor hour. Labor hour is limited. You require 1290, but you have only 1200. In such a situation, you know you cannot produce 100 units of A, 150 units of B, and 120 units of C. Now, what is the solution? How you can set your production mix? From A how much you can produce, from B how much you can produce, and from C how much you can produce. Let's take the whiteboard and solve the question. When company or entity having one limiting factor, why I am taking one limiting factor? Because sometimes material type A, material type B, likewise you have more limiting factor. But here we are discussing when entity having only one limiting factor. What is the number one? Compute contribution per unit. Contribution per unit. Now you are producing A, B, and C. You can easily take the contributions. It is given sales price and variable cost. If you refer product A, your contribution will be 120 per unit. If you product B, your contribution will be 140. If you take product C, contribution will be 140. Am I correct? 180 minus 60, 120. Then 220 minus 80, 140, then 210 minus 70, 140. First step, contribute contribution per unit. Then identify limiting factor. I use LF, limiting factor requirement per unit. It is already given. For product A, B, C, limiting factor is labor hours. You require 2 labor hours for A, 3 labor hours for A, 5 and 2 labor hours for B and C, 5 and 2 labor hours for B and C. Then is step number 3. Compute contribution per limiting factor, that is you need to divide answer of A by answer of 2, right? Compute contribution per limiting factor. Now see, if you produce 1 unit of A, see this is very important point to understand. If you produce 1 unit of A, you require 3 labor hours. That means 1 labor hour will generate 40 rupees for you. 1 divided by 2, 120 divided by 3. If you produce 1 unit of A, total contribution 120 from 1 unit of A, but it take 3 labor hours. Therefore, per labor hour, you can have 40 rupees. In respect of product B, 140 per 1 unit, but it take 5 labor hours. Therefore, 1 labor hour gives you 28 rupees. Then, in respect of product C, 140 per 1 unit, which take 2 labor hours, therefore per labor hour it gives you 70 rupees. Now, as a rational investor, you believe I must produce more, which gives highest contribution per labor hour. Therefore, Roman number 4, rank the product. You have to rank the product from highest contribution per limiting factor. You have to rank the product from highest contribution per limiting factor. Therefore, number 1 will be product C, highest contribution per limiting factor. Number 2 will be product A, 40, next highest, and number 3 will be product B. Therefore, you must first produce product C, then you must produce product A, finally you must produce product B in order to maximize your profit. Now, based on the rank, you can produce your quantity. Let's see the last step, step number 5, right? Last step, how to decide the maximum profitable product mix. Now you know your rank for product C, A and B. The quantity you can produce from C, 120, from A, 100, and from B, 150. Labor hour per unit. C will take 2 labor hours, A will take 3 labor hours, B will take 5 labor hours. Let's see total labor hours, the limiting factor. You can produce C first. To produce 120 C, it's require 240. Altogether you have 1200. Now you already consume 240 labor hours. Further you have 960. Therefore you can produce all A. 100 units will take 3 per unit. Therefore it's take 300 labor hours to produce A. Now you already consumed, see, you already consumed 540 labor hours. You already consumed 540 labor hours out of 1200. What is the balance? Your balance labor hours will be 660, right? 660. Now you already produced this, you already produced this. You now considering the production of B. Available labor hours is 660. Let's see from 660 how much we can produce by using 5 hours per unit. Divide 660 by 5. You can produce 100, not 150. You can produce 130 2. That's how you have to decide, right? That's how you have to decide your production plan according to the limiting factor analysis. Now you have given 5 steps, this is the last step. Therefore, from product A you can produce 100, from product B you can produce 132, and product C you can produce 120. Therefore, answer will be answer A, 100, 132 and 120, right? I think you got the idea what you need to do. I will repeat what are the steps, right? You have to follow here. Number 1, see how many limiting factors you have. Here you have only one limiting factor, that is labor hour, right? Then see how many labor hours deficit, like this, right? We calculated then how many labor hours deficit. Then calculate contribution per each product. Then find out how many limiting factors required for each product. Then calculate contribution for each limiting factor. This is step 3. Then based on the contribution for each limiting factor, you can rank the product from highest contribution per limiting factor to lowest contribution per limiting factor. Then based on the ranking, plan your production as discussed in this question. However, this questions brings you only 2 marks, that is 2.4 minutes. You have to do this within 2.4 minutes. Then how we can easily reach without doing the total calculation, because this total calculation take more than 5 minutes. Here, first rank the 3 products. Once you rank the 3 products, right, you know the number 1 is C, number 2 is A, right, number 3 is B. Since C become number 1, entire 120 you can produce, but you have 3 answers bring 120. You can ignore B, but A, C and D you have to refer, clear, because you have 320s. Then you know the number 2 is A. Since the deficit is only 90, now we have calculated here, deficit only 90 units, right? We can produce entire amount of A, the number 2, that is 100. Now you have filtered A, C and D. Base you have filtered A because C 120, you have filtered C because C 120, and you have filtered D because C 120. Now second product you can produce is A. Since the deficit only 90 hours, you can produce entire 100. Then when you take the A quantity, 100 given only for 2, that is A and C. Therefore, you can eliminate D from the answers. Now you have only 2 answers, clear? Since there is a deficit, you know you cannot produce B 150. Therefore, this answer cannot be the answer. Therefore, you can eliminate C also from the answer. Then finally, it will be ended with A. That is the shortcut method. You have to go for this without doing this calculation. But if you can do that calculation within 1 or 2 minutes, just do it. Otherwise, use the method I have explained here, the shortcut method, to achieve the answer, right? Now, next question, again a bigger question, right? Here is a bigger question. Question number 35 to 39, 5 questions, that is 10 marks, that is 12 minutes allocated for these 5 questions. 12 minutes allocated for this question. What are the information? Let's see. Asher company is planning to invest on a project that has initial investment 780,000. Annual forecasted cash inflows for 5 years. These are the 5-year cash inflow. This is the initial outlay. Actually this is a project appraisal. Definitely you will have question from project appraisal techniques. Before moving to this, let's see what are the project appraisal techniques. Here this is a project. Now you have to remind what are the project appraisal techniques available, right? We have payback period. Payback period is a one project appraisal technique, or you can use discounted payback period, right? You can use discounted payback period, or you can use accounting rate of return. But important, when you calculating accounting rate of return, this is very important to keep your mind. Why? Accounting rate of return doesn't have clear cut formula. Therefore you have to be careful when you answering for MCQ question, because you need to exactly use the formula used by the examiner to reach the answer that examiner wants, because accounting rate of return not includes a clear defined formula. There are many formulas. I will explain once I going to calculate that. What are the other method? You can use net present value of the project, or you can use IRR of the project. These are the very famous techniques we can use to appraise a project. Payback period, what is it? What is payback period? What is the time period required to recover this initial investment of 780,000 within this 5 years period? What is discounted payback period? These are future cash flows. You need to take the present value of these cash flows. Thereafter you will evaluate what is the time period required to recover 780,000. Then accounting rate of return. This is cash flow. You need to calculate the accounting profit. Once you calculate accounting profit, you have to calculate the average accounting profit. That average accounting profit for 5 years can be divided by the investment, or average of this investment, that is divided by 2. Many methods you can use. Let's see what examiner expect based on the answers. Then you can calculate NPV and you can calculate IRR. Without going to the answers, let's see the answers for all the 4 methods. How many methods we discuss here? 5 methods. Let's try to calculate all these 5 methods. I think all 5 these questions raise about all these 5 methods. Let's see the question. Number 1. Yes, uses 12% discounting factor. Depreciation rate is 20% for the accounting rate of return. This is only important for accounting rate of return, because accounting rate of return required the accounting profit. Therefore you need to deduct depreciation from the cash flow. Otherwise it is not required. Cost of capital is required to discount. Question number 1, payback period, that is 35. Then 36, discounted payback period. 37, accounting rate of return. 38, NPV, and 39, IRR, right? All the 5 methods they requested you to do. Let's calculate all these 5 answers using this information. However, to do these things you have only 12 minutes. Okay, let's calculate the areas, the 5 appraisal techniques we have discussed, because the same appraisal techniques was tested in the 5 questions. Let's take the basic information. At year 0, you are investing 780,000, that is the initial outlay, the cost. Then year 1, net cash inflow 150,000. Year 2, 220,000. Year 3, 340,000. Year 4, net cash flow 400,000. Year 5, net cash flow 300,000. Right. Now the question 35 requests the payback period. The payback period is how many years which takes to recover 780,000. You can see at year 0 it is 780,000, right? Since you recover 150 in the first year, that 780,000 will reduce by 150,000, that is 150,000 recovered, and balance will be 630,000 to be recovered after the first year. Then second year you will recover another 220,000, therefore we can reduce 220,000 further, then you have to recover 410,000 further. Then third year you can recover another 340 out of here, therefore reduce 340,000 from 410,000, then you can see you have to recover further 70,000. That means you already completed 3 years, but you have to recover another 70,000. Therefore, fourth year you can earn 400,000. Therefore, no need to spend entire fourth year to recover 70,000. Therefore, payback period will be 3 years, right? 3 years and the number of months. How we can calculate number of months? Because in the fourth year it will give you 400,000, but you need to recover only 70,000. Therefore, you will divide 70,000 by 400,000 multiplied by 12 months. Then you can see number of months required, right? 70,000 divided by 400,000 multiplied by 12 months. 70,000 divided by 400,000 multiplied by 12 months, that is 2.1 months. Therefore, 3 years and 2.1 months required. This is the payback period. Let's see the answer now in the question number 30. In the question number 35 given. Right, you can see here the payback period 3 years and 2 months. Approximately they have given it is 2 months, but actually it's take 2.1 month, but approximately rounded number of months 2 months, right? Thereafter, question 36 request you to calculate discounted payback. That means let's go into the screen again. Okay, now let's calculate the discounted payback. To calculate discounted payback, we need to have discounted value of future cash flows. They have mentioned their cost of capital is 12%, that is discounting factor must be set at 12%. Let's take discounting factors, right? You can use the table given in the exam or use the calculator. Here 1 divided by 1.12 power 1, that is 0.893, then 0.7 power 2 97, then power 3 0.712, then power 4 0.636, and finally power 5 0.567. Now let's take the present value of the future net cash flows. 150,000 into 0.893, 133,950, 220,000 into 0.797, 175,340, then 340,000 into 0.712, 242,080, then 400,000 into 0.636, 254,400, then 300,000 into 0.567, 170,100. Now we require to recover 780,000 which was incurred at the year 0. First year you have recovered this much. Then how much the remain cost? 780,000 minus the first year net cash flow at its present value, 133,950. Then at the end of the first year you require to recover further 646,050. Then second year you will recover this much at its present value. Deduct this much from here and see the remaining balance to be recovered. 175,340 will be reduced. Then you need to recover further 470,710. Then third year you will recover 240,080 from this. Then see the remaining balance. Then at the end of the third year you need to recover further 228,630. Then fourth year you will recover 254,400, right? 254,200, but you need to recover only 228,000. Definitely no need to spend entire year because you can recover in the fourth year more than to be recovered. Therefore we can set 3 years and number of month. You need to recover 228,630 out of 254,400 into number of month. Let's see the number of month. 228,630 divided by 254,400 into 12. That is 10.7, 3 years and 10.7 months. It can be rounded because we have to provide in months. 3 and 11 months. You can see your answer. The question number 36, answer is B. 3 and 11 months is the answer, right? 3 and 11 months is the answers for the question 36. The discounted payback period 3 years and 11 months approximately. This is the answer for question 36. Now let's move into the question 37. I think you have the question with you, or you can download the question paper from the website. The question 37 asks accounting rate of return. Now this is the crucial next calculation. Why? Accounting rate of return can use different formula, right? Accounting rate of return will have different formula. I will give you the formula first. Year 0, 780,000 is the investment. The accounting rate of return AAR, accounting rate of return equal average accounting profit, not the cash flows, right? Accounting profit divide by average investment, or again average accounting profit divide by investment. Any method you can use, but you have to check whether which method they have arrived their answer. Is that clear? In which method they have arrived the answer. First we calculate average accounting profit. To calculate average accounting profit, right, this is the initial investment. These are the first year to 5 year net cash flows. To obtain accounting profit, what we have to do? We need accounting profit, right? We need accounting profit. To obtain accounting profit, you need to reduce depreciation. Let's remove the investment here. You need to reduce depreciation to have the accounting profit. This question clearly mentioned, right, the cost of the investment 780,000 and will be depreciated over 20% per annum on a straight line basis. That means originally you have 5 years, therefore entire asset will be depreciated over the 5 years up to 0. Therefore no need to depreciate year by year. You know, finally entire 780,000 has to be depreciated over 5 years since it is 20%. To save the time, what we can do, don't take one by one, since this is 5 years and depreciations also in 5 years, and finally entire 780,000 will be depreciated. Take the totals of revenue immediately. The total profit, total net cash flow how much? 150,000 plus 220,000 plus 340,000 plus 400,000 plus 300,000. Now total net cash flow for the 5 years will be 1,410,000. Then deduct cost, because even it depreciated over 5 years, 20% by 20%, deduct total cost from the total net cash flows is same. Therefore you can deduct 780,000 from here. Now you have total accounting profit. Total accounting profit will be 630,000, but you need average accounting profit, right? Therefore average accounting profit will be, let's take the both methods. Average accounting profit will be 630,000 divided by 5. 630,000 divided by 5. Once it's divided by 5, it is 126,000. 126,000. Now to calculate accounting rate of return, you can use average investment or investment. Average investment means you will take initial investment and investment value at the end of the 5th year divide by 2. Now investment value at the end of the 5th year 0, that is no scrap value. Investment value at the end of the period is the scrap value. Therefore initial investment plus scrap value divide by 2. Here you will take only initial investment. Now here initial investment 780,000, no scrap value, since it is divided by 2, right? 780,000 divided by 2, 390,000. Here you will take as it is 780,000. Let's see the 2 percentage. 126,000 divided by 390,000. The percentage will be 32.3. Accounting rate of return. Here 126,000, we are using 2 methods, right? Because there is no clear cut method to calculate accounting rate of return. We will divide by total investment, then it is 16%. Now see which answer they have given in their answer list. They have given 4 answers. 13% accounting rate of return, 13% not match with the both answers. Then 63%, it is not matched with the both answers. 31% not matched with the both answers, and 16%. Here 16% match with the second option we have used. Therefore answer would be 16, right? Therefore answer would be 16. That is the accounting rate of return. I think you are getting understanding how to calculate the accounting rate of return also. Now the next question, the question 38 asks what is the net present value, and 39 asks what is the IRR. Let's calculate both in the same table, then easily we can solve this question. I am already erased the previous present value calculation, but you already have present value calculation if you had the exam. Therefore, don't worry, you have the present value calculation at the exam. Therefore, find out the net present value at the discounting factor of 12%. Since it is here 0, it is 1, right? I have to take it again. I will quickly take it. 1 divided by 1.12, that is 0.893, 0.797, 0.712, 0.636 and 0.567. Now you can immediately take the present value. Initial investment is stood at 780,000 since it is today, right? We have to calculate the present value here. Immediately we can do that. 893, that is 133,950.797 into 202,000, 175,340.712 into 340,000, 242,080, 636 into 400,000, 254,400, finally 567 into 300,000, that is 170,100. Now the net answer is the net present value. Let's see the net present value. It would be 195,870. Let's see, 195,870 will be the net present value. You can see, I think you have the paper on your hand also. The net present value 195,870, right? It would be 195,870 net present value. Now our next duty is to calculate IRR. You know, to calculate IRR, we have to have another present value calculation which gives minus NPV. You have to decide a discounting factor which gives minus NPV. Now at 12% it is 195,000, right? Therefore we can double it. Let's take 24% discounting factor. Then discounting factor 1, then 1 divided by 1.24, 0.806, 0.650, 0.524, 0.423 and 0.341. Now let's take the present value. Here it is stood at 780,000 since it is at the year 0. Other values 0.806 into 150,000, 120,900, 0.65 into 220,000, 143,000, 0.52 into 340,000, 178,000, 160, 400,000 into 0.423, that is 169,200, and finally 300,000 into 0.341, that is 102,300. Let's see the present value. 120,900, 143,000, 178,160, 169,200, 102,300 minus 780,000, that is the initial investment. You have minus NPV 66,440, right? Now you know thereafter what you have to do. You have to use a formula, but don't try to cram this formula. There is a technique to arrive this formula. This is an additional part, no need to practice always, but you must know how the formula arises for IRR. Let's see. Let's take for this line the net present value, and for this line the discounting factor. Here 0, plus values, minus values. Now you can see that at 12% it is 195,000, right? Let's take 50,000 by 50,000, then 195,000 at 12%. At 12%, 195,870, right? 195,870 at 12%. Now at 24%, when the rate doubled, 24%, it is more than 50% but less than 100,000. Therefore, this is the area we can consider. Now see, at 12% you have 195,000 plus, at 24% you have 66,000 minus. Now you can combine these two lines. Now this is the NPV line. Now this NPV become 0 at this rate. There is a rate, right? Because this is the discounting factor rate. This rate NPV becomes 0. Therefore, this is the IRR rate, right? How you can calculate this? We know your rate, IRR rate always, right? This IRR rate always more than 12%. That's why you take 12% plus, right? Then you know it is always less than 24. You know, in this point it is 195,870. This point minus 66,440 was the NPV. When the rate increased from 12 to 24, when the rate increased in between this, that is when the rate increased by 12%, right? Difference is 12%. You can see from 12 to 24, it is increased by 12%. When it is increased by 12%, total NPV, the total NPV has been changed from this point to this point. Can you see that? When the rate increased 12% to 24% by 12%, total NPV reached from plus 195,000 to minus 66,440. That means to take this total distance, assume this total distance in kilometers, then you have to add two numbers, right? You have to add two numbers, ignore the sign. If you consider sign, you can't take the total distance. To have the total distance, you need to take 195,870 plus 66,440. This is the total distance, the sum of these two, right? If I take the sum after adding 195,870 plus 66,440, total distance is 262,310. This total distance arises due to 12%. Clear? 262,310 due to 12%. But we need up to this point. We need up to this point. That means we no need to consider this distance. we need to consider this distance. Why? When it's come to here, rate become to the IRR. Therefore, this distance only 195,000. 195,870. If 195,870 out of this much, how much out from the 12? That is the formula. If 195,870 out of 262,310, how much out of 12? Let's solve this. 195,870 divided by 262,310 multiplied by 12 plus this 12. Therefore, rate would be 21 or 20.9. Here we have the rate 20.9, right? Now, next point, next important matter you need to consider the rates you are using. Now, definitely you will use 12% here for the first NPV calculation. Thereafter, you can use 20% or 24% or 15%, whatever rate which gives minus answer. When you are using different rates, you will have different IRR, but changing approximately little decimal points. Therefore, you may not receive exactly this answer, but out of the 4 answers, you will have more close answer to this. Therefore, don't worry if you are not receive exact answer in the out of 4 answers. See what is the most close answer to the answer you reach. Why? When you are getting the second discounting rate, your answer will vary. If you take 15%, different answer. If you take 20% here, different answer. If you take 25% here, different answer. Since we have 24, we have 20.9. Let's see the answer given in the 4 answers list. The most close answer is 20.4. We reach 20.9. Therefore, answer would be D. Right. From this calculation, we have discussed, right? We have discussed how to use all the project appraisal techniques together. If I remind it to you again, for the project appraisals, we can use payback period. What is payback period? What is the time required to recover initial investment? You need to take net cash flows of each years, then see how many years it required to recover total investment made in year 0. That is the payback period. Then we have calculated discounted payback period. It is the same technique, but the net cash flows will be taken to the consideration after discounting. Once you discounted all future net cash flows, again you can calculate payback period after discounting the future cash flows. That's called discounted payback period. Is that clear? Right. Then we have calculated accounting rate of return. What is accounting rate of return? We are calculating average accounting profit as a percentage of the investment. That is the requirement. Average accounting profit as a percentage of the investment. Very important to keep your mind. Sometimes examiner will give you net cash flows for all the 5 years like here given. Here they have given net cash flows. You can refer the question again. These are the net cash flows for the 5 years. This is not reflect the accounting profit. To reflect the accounting profit, you need to deduct the depreciation from each year. Once you deduct depreciation from each year, you can have accounting profit. Thereafter, you have to calculate the 5-year total accounting profit. Then you have to calculate the average accounting profit for the 5 years. Once it's divided by average investment or in the investment, you can have accounting rate of return. Sometimes examiner will give you accounting profit. In such a case, no need to deduct depreciation again since they have given the accounting profit. But to calculate present value or discounted values, you need to add back the depreciation again to the accounting profit, because when you discounting cash flows, you are not deducting depreciations, right? That's how you have to change according to the question. Thereafter, we have calculated net present value. Net present value is the discounted value of future cash flows discounting by the cost of the project and compare with the initial investment, we will give the net present value. And finally, I have explained how to calculate the IRR of the project. Now, this question covered all the technical areas of the project appraisal techniques. But in addition to this, there may be another additional question from this area. Those are the advantages and disadvantages of project appraisal techniques. Now, what are the advantages of payback period? What are the disadvantages of payback period? Then what are the advantages and disadvantages of NPV? What are the advantages and disadvantages of IRR? What are the advantages and disadvantages of accounting rate of return? Now, difference between NPV and IRR. Difference between IRR and ARR, that is IRR and accounting rate of return, or NPV and accounting rate of return. You know, in accounting rate of return, you will deduct depreciation, but NPV IRR, you are not deducting depreciation since it is already deducted at year 0, 780. No need to deduct it again. But accounting, you will deduct over the period at depreciation. Further, you can say depreciation is not a cash flow, but actual theory is when you calculating NPV or IRR, no need to deduct depreciations since entire investment of 780,000 will be considered as an outflow at year 0. Then why you are deducting depreciation again? If so, you will be double counted. Therefore, to eliminate double counted, since you are deducting at year 0, no need to deduct it again from 1 to 5 years, right? Now, just see that advantages and disadvantages as well as the differences reference to your study text. We are now moving into the next questions. Now, question 40. Which of the following statement is correct regarding the cost of capital and net present value of the investment? When the cost of capital, answer A, there is a positive relationship between cost of capital and NPV. No. I will give you onto the whiteboard again. See the calculation we have made for the previous question. Now, the first NPV calculation. The NPV 195,870 plus answer at 12% discount rate, at 12% cost of capital. If you assume cost of capital 12%, NPV 195,000 plus. If you increase cost of capital, in other words, discounting factor for 24%, NPV has decreased. You can see that. At 24% discounting factor or cost of capital, NPV taken minus 66,000, right? Approximately. Now, there is a relationship. I think you can understand the relationship on the board. Why? What is the relationship? When the discount rate increasing, NPV will decrease. Therefore, there is an inverse relationship or the negative relationship in between NPV and cost of capital. Therefore, answer A incorrect. It is not a positive relationship. It is a negative relationship between NPV and cost of capital. It is clearly appearing on the board, right? Appearing on the board. When the rate increased from 12 to 24, NPV reduced from 195,000 to 66,000. Therefore, it is a negative relationship. Moving again into the computer screen, we can see that there is a negative relationship between cost of capital and NPV. Okay, moving with question number 41. There is a blank. Budget starts with assumption that current activities in a company will not automatically be continued in the next period. It's a very nice question. There are different methods of budgeting, right? One method is zero based budget. The answer is zero based budget also. What is zero based budget actually? Zero based budget means generally, traditionally, most companies preparing their budget using the recent financial year or recent financial years historical data, using trend analysis or using different mathematical models, regression and correlation analysis. They are take past financial informations to develop next year budget, right? That means next year budget assume the past year's information will continue, because you will use mathematical models such as trend analysis or the simple regression or the correlation called multiple regression or simple regression or multiple regression, such as trend analysis, right? You try to use past pattern to the next year also. That is a traditional way of budgeting. But zero based budget means you are not trying to take anything of the past. You are trying to think newly. You believe this is the first financial year. You take everything with a fresh mind, ignoring the past information. Since you are not considering the past information, company will continue at zero. That's why it's called zero base. No carry forward of the past practices to the next year. Therefore, answer would be zero base budget here. Then 43, 40, 42 and 43 questions relating to this information given. Let's see. Delco company has given following information on his sales forecast. January, February, March and April. Budgeted sales is given. Cost of goods sold, that is cost of sales, that is 60% of the sales value. The inventory at the beginning of January, that December end 2018 means beginning of January 2019, because this January, February, March, April for 2019, they have given closing inventory at the end of 2018, that is 19,440. That should be the opening inventory of January. Desired ending inventory would be 20% of the next month's sales. If somebody asks what would be the inventory of January end, that will be the 20% requirement of February. What would be the inventory of February end, that is the 20% requirement of March sales. What would be the March end inventory, that would be the 20% requirement of April sales. But keep your mind, this is shows your sales in sales price, right? Inventory has to be taken on cost. If you calculate your sales using sales, that inventory need to be taken into a cost. Now question is, what is the desired ending inventory, closing inventory of the month of February 28/2/2019 means February. They are asking February ending, February end inventory, right? End of February stocks. Now each month end inventory will be 20% of the next month sales. Now next month sales, that is March sales, 144,000. This 144,000 represent the sales value, not the cost. However, let's take the cost value. Now 20% on this will be the closing inventory for February. Now how much the 20% on this, right? That is 28,800. But this 28,800 represent sales value. Sales value cannot be taken as the inventory value. Therefore, you need to eliminate the profit margin from here. Now closing inventory for February 28,800 at sales value. The 60% is cost of sale, therefore you need to take 60% as the cost. Then how much? 60%. 28,800 into 60%, that is 17,280. Now you can see the answer, 17,280. Very important point in this type of questions are, ensure the inventory need to be presented at their cost, not at their sales price, like we calculated here. Now let's see the second question. If the selling price per unit 200 rupees, what is the required production quantity in March? If the selling price is 200, what is the production quantity in March? Let's take the March now. Right. What is the production quantity in March? Right. March production quantity consists, right, open stock, right, open stock plus March production minus March end stock equal sales units, right. If you take open inventory of the March plus March production minus March end stock, you can have sales units of the March. Now here you have sales units of the March. Clear? This is the sales unit of the March. Sales revenue 144,000 for the March. Sales revenue 144,000 for the March. Selling price they mention, assume as 200 rupees. If selling price 200 rupees, clear? If selling price 200 rupees, the quantity sold in March, sales unit will be 720. Let's check it again. 144,000 divide by 200, 720 units. Now we need to calculate open stock and end stock. Open stock will be the February end. End stock will be the March end. How we have to calculate end stock? Now open stock, March open stock is the February end stock. February end stock in quantities, right? February end stock need to be calculated in quantities. That is a very important point, right? Now February end stock will be depend on March sales requirement. 20% of March sales requirement will be the February end. That will be the March beginning, right? Now March sales requirement 144,000. Ready? Divide by 200. That is 720. Now March sales requirement in quantity 720. 20% out of that, 20% out of March sales requirement will be February end stock. Therefore, February end stock will be 144 units. That February end stock will be the March beginning stock 144. Clear? Now using the same technique we can calculate March end stock. March end stock will be April sales into 20%. Now how much the April sales? April sales 120,000, right? 120,000 divided by 200, then total quantity 600. Out of 600, 20% will be the March end stock. March end stock will be 120. Now you can calculate March production easily. How? This is the only value you need to find out. All other values available. Therefore, March production will be 720 plus 120 minus 144. Therefore, March production will be 696. This is the answer. I think you got how I have reached this. I initially write down the formula. Then I have substitute the available figures into the formula and find out the required answer as the unknown factor. Therefore, answer would be 696. Right. Then let's move into question 44. Question 44. A company has the following sales budget for the last 6 months. Sales budget for the last 6 months. Right. Now, then they have explained how this sales value will be collected. 65% in the same month, 25% in the following month, 8% in the second month, 2% uncollectible. Now, question is, what is the expected cash collection in October? To calculate this, we require to calculate cash budget for these 3 months, especially for cash collection. Now they are asking, what is the cash collection of month of October? Month of October cash collection. Let's calculate. Month of October cash collection, 65% from October sales, because 65% of sale in the same month they will collect. Therefore, 80,000 into 65% can be collected in October. That is 80,000 into 65%. Answer will be 52,000. Right. Now, all other collections relating to the October sales will be occurred after the October. Why? 25% in November, 8% in December, 2% cannot be collected because only 65% will be collected within the same month, balance after that month. But we need cash collection of October. Therefore, we can take only 65% of October. Balance will come from the previous month. Got it? Balance come from the previous month. Now, you know 25% of sales will be collected in the subsequent month. That means during the October, you will collect 25% of September sales. That is 110,000 sales in September. Out of that, you can collect 25% of sales in the October. Then 110,000, 25%. That is 27,500 can be collected in October relating to September. Then you know 8% will be collected in the second month. Therefore, in October, 8% can be collected 2 months ago, that is from August. From August, you can collect 8%. Therefore, August sales, this is August, right? August sale also 80,000. Out of that, you can collect 8%. The value will be 80,000 into 8%. 6,400 can be collected within October. Therefore, total collection will be 6,400, 27,500 plus 52,000. Total collection would be 85,900. Let's see. Yes, answer will be 85,900. That is sum of these three values, right? Sum of these three values will be 85,900. Therefore, total collection in October 85,900. 61% can be collected from October itself, then 25% can be collected from the previous month, that is from September, then another 8% can be collected after 2 months. Therefore, in October you can collect 2 months ago sales, that is from August. That's how we have calculate the total collection from October as 85,900. This is cash budget technique, right? You have to practice this more to answer this type of question at the exam, right? Let's move into the question 45. Spending less than budget for maintenance cost. When you spend less than budget for cost, it is favorable. Therefore, first blank is favorable. When actual revenue exceed budget, when the revenue exceed actual, again revenue when it is exceeding, again it is favorable. Therefore, second blank also favorable. Therefore, answer will be D for these two blanks. Now 46 to 47, two questions depend on this description. Let's see. Trust company has following information of their production and material usage. Budgeted production quantity 80,000 units, 80,000 which expected to consume 88,000 kilograms of material at total cost of 880,000. Company produced 90,000 units in a month. Actual cost of direct material 82,000 and total cost of 984,000. What is the direct material price variance? I told you, I think you can remember in the first video we have discussed the variance analysis formula for material, labor, variable overhead and sales. Right, now they are asking what is direct material price variance. Okay, to calculate direct material price variance, first think about the formula. Formula will be, I will give you the formula here, right? Standard price minus actual price into actual quantity. Now let's see what are the figures for this formula, right? What is the standard price per unit of material? What is the actual price per unit per material? And what is the actual quantity? The company has following information. Budgeted production quantity 80,000, it is not required, which expected to consume 88,000 kilograms of material at a cost of 880,000, that is budgeted information. Total budgeted cost 880,000. Number of quantity expected to use 88,000. Therefore, standard price would be 10. You can say standard price per unit is 10. Why? This information 80,000 units budgeted, quantity required budgeted, cost budgeted. Therefore, standard price per unit 10. 880,000 divided by 88,000. Therefore, it is 10 is per unit. Now, company produced 90,000 units. Actual cost of direct material 82,000 kilograms, 984,000 per kilogram. Now let's see the actual quantity. Actual cost per material 984,000 is the actual total cost. number of kilogram used 82,000. Therefore, actual cost incurred per material is 12. Now you can see you have incurred additional 2 rupees per kilogram. What is the actual quantity you consume? That is 82,000. Therefore, answer will be 164,000. Since you have incurred additional 2 rupees more, that is adverse variance. Answer 164,000 adverse variance. Right? Now let's move into the second question. They are asking material usage variance. Material usage variance. Again I will give you the formula. Material usage. This is cost. Therefore, we start with the standard. Standard quantity in actual production. In actual production minus actual quantity into standard price. Let's take the standard quantity in actual production. How much the actual production? How much you actually produce? 90,000 units. Right? What would be the standard quantity per unit? Budgeted production 80,000, which expected to consume 88,000 kilograms. That means according to the standard 88,000 kilograms required to produce 80,000 units. Therefore, according to the standard you require 1.1 kilogram per unit. Clear? You require 1.1 kilogram per unit, but you actually produce 90,000 units. Therefore, you can say how much standard quantity in actual production, then minus actual quantity, that was 82,000. Right? Then you can multiply it by standard price. It was already calculated as 10. Therefore, answer will be you produce 90,000 units. According to the standard, 1 units require 1.1. Therefore, you must consume 99,000 units, but you have consumed only 82,000 units. Right? What is the saving? You have saved 17,000 units at 10 rupees. Therefore, you can save 170,000 rupees. That is favorable. Therefore, answer 170,000 favorable here. 170,000 favorable your answer. Right. Now we are in the last 3 questions. 49, 48, 49 and 50 will depend on this information. Actually, this is about inventory ledger. Let's see the information. A company values its inventory using FIFO method. At 1st April 2020, company had 700 units in inventory, valued 190 each. During the year end, following transaction took place. Let's prepare immediately the inventory ledger for this inventory transaction. Let's take a table now. You know, when we preparing inventory ledger, we need major 3 columns, right? First column, take inputs, right? Inputs. Second 2 columns we can take outputs. Then last 3 columns we can take, last column we can take balance, right? Let's prepare on the whiteboard, then easily we can understand it. Right. You have the question with you, therefore I will use whiteboard. Now we need to prepare inventory ledger. We know this, they are using FIFO in this inventory ledger. Received, issued, balance. That's how you preparing your inventory ledger, right? issued and balance. Since you have 3 questions, you can immediately prepare this using your draft sheets. Quantity, price, value, quantity, price per unit, value, quantity and value. Let's take. At the beginning, they had the balance, right? They had the balance 700 quantity, value 190 each. Then 700 quantity, right? 190 each, 700 multiplied by 190, therefore value will be 133,000. Then what happened? 1st July, 500 units purchase, 500 units purchase at 220. What is the total value? 500 unit at 220, 110,000. 110,000. Therefore, your quantity increased to 1200, value increased to 243,000. That means you need to add this value and this value have the balance. Then November, you have sold 400 units, that is issued 400 units sold, right, for 160,000. 400 units sold for 160,000. Now you have to issue this amount from your ledger using FIFO method, first in first out. Therefore you have to issue entire 400 from here, because entire 400 you can take from the first in first out, because this is the first in, therefore you can out it. Now entire 400 can be priced using 700 and 133,000. Now 133,000 for 700 units, therefore per unit 190 multiplied by 400, then value will be 76,000. Then quantity reduced to 800 once you issue 400, and value reduced to 243,000 minus 76,000, that is 167,000, right? However, keep your mind, out of this 700 you already issued 400, you have a balance of 300 there, right? Then February, they have purchased again 300 at 230, 300 at 230, value 69,000. Then you need to add to the balance. Now you have 1100 quantity, 300 and 800, 1100, value will be 167,000 plus 69,000, 236,000. Now finally what happened? They have sold again 250 units. 250 units. You need to issue the cost. Here still you have 300 units. Since you have issued only 400, that 300, that therefore 250 you can issued out of this 700, because you have remaining 300, right? Therefore 250 multiplied by 190, 47,500, 250 minus 1100, 1100 minus 250, remaining quantity 850, value 236,000 minus 47,500, value will be 180,500, right? This is the closing inventory. Now let's see what are the questions raised. Question, I think you can, okay, Suraj will support to turn the camera. Question number 1, what is the, number 1 is the 48, right? What is the value of the company's closing inventory? Now Suraj will turn camera on to the white screen. See the white screen, you can see the stock ledger. What is the closing inventory? That is the balance, closing balance. The value of the closing inventory 188,500. That's why answer in 48 mentioned as 188,500. Right. Now question 49. What is the cost of sales for the period? Cost of sale for the period. Cost of sale for the period means the cost of the items issued. This is for 48 question 48. This is for question 49, right? Cost of sale means cost of the item issued, because you sold it. The sum of these two. Let's see the value. 76,000 plus 47,500. 123,500. You can see answer given as 123,500. And final question in the pilot paper. What is the gross profit for the period? The gross profit will be the sales price minus cost of sale. The total sales price, to take the total sales price from the company, right, you have to go to the information given in the question. You have made two sales, November sold, March sold. Therefore total sales price 160 and 125 only. That is this and this. November and March you have sales. These are the sales prices, 160 and 125,000. 160,000 plus 125,000. Then total sale value during the period 285,000 minus cost of sale we calculated. We already calculated cost of sale in the question number 49. Cost of sale 123,500. We will reduce that cost of sale from total sales. That is 123,500 we will reduce from the total sales. Then 161,500 is the gross profit earned during the period. Therefore, you can understand if there is a question that like this, see how many questions they raised. See how many questions they raise. If they raise more than 2-3 questions, better to prepare the table and answer directly, because you can take exact correct answer using the table. That is the end of the discussion of pilot paper for BL6 English medium, management accounting English medium business level. I think you received a fruitful discussion. I try to discuss the theories around these questions, not only the 50 questions. Therefore, watch this video, not only these 2 videos discussion of pilot paper. We have 9 videos completed for the business level management account in BL6 revision program, right? It was completed in end of February and March, beginning of March and end of February. Take those 9 videos, watch those 9 videos and watch these 2 videos, then you can pass this exam. I will wish you all the best to pass the exam. Thank you very much.